The year is 2025. The Earth is warming. Glaciers melt at an alarming rate. Wildfires rage across continents. The consequences of climate change are no longer a distant threat. They are our present reality. In the face of this global crisis, a glimmer of hope emerged from an unlikely source: the financial sector. Banks, those titans of industry, pledged to align their practices with the urgent need for climate action. They joined the Net Zero Banking Alliance, a global coalition committed to achieving net zero emissions by 2050. But hope can be a fragile thing. Recent events have cast a long shadow over the financial sector's climate commitments. Major U.S. banks, once symbols of this newfound environmental consciousness, have made a startling about-face. They are abandoning the NZBA, retreating from their pledges, and raising profound questions about their true commitment to a sustainable future. This is not just about broken promises. It's about the erosion of trust. It's about the power dynamics between Wall Street and the planet. It's about the choices we make today that will determine the world we inherit tomorrow. The Net Zero Banking Alliance emerged in 2021 as a beacon of hope in the fight against climate change. Born out of the Glasgow Financial Alliance for Net Zero, the NZBA united over 140 banks from 44 countries under a common goal: to align their lending and investment portfolios with the Paris Agreement's goal of limiting global warming to well below 2 degrees Celsius. The alliance's premise was simple, yet powerful. Banks wield immense financial influence, channeling trillions of dollars into various sectors of the global economy. By leveraging this financial might towards clean energy, sustainable infrastructure, and climate-resilient development, the NZBA aimed to accelerate the transition to a low-carbon future. The initial response was encouraging. Banks, recognizing the growing risks posed by climate change to their own balance sheets and the global economy, embraced the NZBA's framework. They set ambitious targets, developed green finance products, and pledged to decarbonize their operations. The world watched with cautious optimism. Could these financial giants, often associated with short-term profits and high-risk ventures, truly become stewards of a sustainable future? The year 2024 marked a turning point for the NZBA, and not in a good way. One by one, major U.S. banks announced their withdrawal from the alliance, sending shockwaves through the financial world and beyond. Morgan Stanley, Citigroup, Bank of America, Wells Fargo, Goldman Sachs. The list read like a who's who of Wall Street giants. These were not small, insignificant players. They were founding members of the NZBA, institutions that had pledged their commitment to net zero emissions on a global stage. Their sudden exodus raised red flags and sparked widespread concern. The reasons given for their departure were varied and often vague. Some cited concerns about legal challenges, while others pointed to the complexities of regulatory compliance. But beneath the surface lay a deeper truth. The political winds had shifted, and the allure of short-term profits once again outweighed the long-term imperative of climate action. The withdrawal of U.S. banks from the NZBA cannot be viewed in isolation. It is inextricably linked to the volatile political climate surrounding climate change. In the United States, the issue has become increasingly polarized, with Republican lawmakers often aligning themselves with fossil fuel interests and actively opposing climate-related regulations and initiatives. These lawmakers, emboldened by a resurgence of conservative ideology and often backed by powerful lobbyists from the fossil fuel industry, have targeted financial institutions perceived as being too woke or overly focused on environmental, social, and governance factors. They argue that these institutions are exceeding their mandate by considering climate risks in their lending and investment decisions, thereby stifling economic growth and infringing on the free market. Texas, a state heavily reliant on the oil and gas industry, has emerged as a battleground in this political war. The state has passed legislation barring state pension funds from doing business with banks that restrict financing for fossil fuel companies. Section 5. Navigating the regulatory maze. A convenient excuse? Banks withdrawing from the NZBA often cite the complexities of regulatory compliance as a contributing factor to their decision. They point to the lack of clear, consistent guidelines from regulators as a major obstacle to implementing their net zero commitments. For instance, banks have expressed concerns about the Securities and Exchange Commission's proposed rules on climate-related disclosures, arguing that they are overly burdensome and create uncertainty in the market. They also point to the potential for conflicting regulations from different jurisdictions, making it challenging to develop a cohesive global strategy for climate risk management. While the need for clear and consistent regulations is undeniable, some critics argue that banks are using regulatory uncertainty as a convenient excuse to backpedal on their climate commitments. They point out that many of these banks have sophisticated legal and compliance departments capable of navigating complex regulatory landscapes. Section 6. Profits over planet. The bank's perspective. Despite withdrawing from the NZBA, banks like Morgan Stanley, Citigroup, and Bank of America maintain that they remain committed to supporting the transition to a low-carbon economy. They argue that their decision to leave the alliance should not be interpreted as a retreat from their climate goals, but rather as a strategic recalibration in light of the evolving political and regulatory landscape. These banks emphasize that they continue to provide financing for renewable energy projects, invest in sustainable technologies, and advise their clients on climate-related risks and opportunities. They point to their ongoing efforts to reduce their own operational footprints, such as investing in energy efficiency measures and procuring renewable energy. However, critics argue that these actions ring hollow in the absence of concrete commitments and measurable targets. They point out that many of these banks continue to finance fossil fuel projects, often at levels that dwarf their investments in clean energy. Section 7. A chorus of dissent voices from the climate front line. The withdrawal of major U.S. banks from the NZBA has been met with a chorus of dissent from environmental advocates, scientists, and community leaders on the front lines of the climate crisis. They argue that this retreat from climate action sends a dangerous signal to the rest of the world, undermining global efforts to avert catastrophic climate change. This is a betrayal of trust, says one prominent climate activist. These banks made promises, and now they are breaking them. They are putting profits ahead of people and the planet. Scientists point to the latest Intergovernmental Panel on Climate Change, or IPCC, report, which warns that the world is on track for catastrophic warming unless drastic and immediate action is taken to reduce greenhouse gas emissions. Section 8. Data speaks louder than words, a story of investments. While banks may claim continued commitment to climate action, the numbers tell a different story. An analysis of their lending and investment portfolios reveals a stark disconnect between their rhetoric and reality. Despite their pledges to support a low-carbon transition, many banks continue to pour billions of dollars into fossil fuel projects, often exceeding their investments in renewable energy and sustainable technologies. For example, a recent report by a coalition of environmental groups found that the 6 largest U.S. banks have provided over $1.4 trillion in financing for fossil fuel companies since the Paris Agreement was adopted in 2015. This figure dwarfs their investments in renewable energy over the same period. This disconnect between words and actions underscores the deep-seated influence of the fossil fuel industry within the financial sector. It also highlights the challenges of achieving a just and equitable transition to a clean energy economy, one that does not leave behind communities and workers reliant on fossil fuels. Section 9. Time to act. Our money, our future. The withdrawal of major U.S. banks from the NZBA is a wake-up call. It reminds us that the fight for climate action is not just about science or technology, but also about power, politics, and the flow of money. It underscores the urgent need for greater transparency and accountability within the financial sector, as well as increased public pressure to hold these institutions accountable for their role in shaping a sustainable future. We cannot afford to wait for banks to act in our best interests. We must demand that they align their practices with the urgency of the climate crisis. We must hold them accountable for their promises and push them to become true agents of change. The future of our planet depends on it.